to the firm. It's not a cost to the firm. So there can't be any withholding tax liability for that.
I'm withdrawing against my existing credit balance. That needs not be treated as remuneration. It gets treated as remuneration on the last day of the year.
Yes, that's what I said. That's what the first question was, that I determine at the end of the year when I am finalizing the account, and therefore that is the time I determine what is the actual remuneration. So that TDS will get attracted then, because that is the time you have determined the remuneration payable. But as
I would request Q&A, you keep it at the, for the end, not in between. You please finish your page. That would be better.
Yeah, I'll just answer this question. So as Riaz pointed out,
Then you forget what is to be asked.
Riaz pointed out that you can estimate the interest and other remuneration payable to the partners during the year, and that is that much you can have your withholding tax on that. Now, one of the important clarifications which are being announced are the TDS on immovable property. There is a limit of 50 lakh rupees, and a lot of interpretation was being taken that it is 50 lakh per transferee, per transferor, and therefore this was not, people were avoiding this withholding tax, and the whole purpose of this withholding tax is to track such sales or purchases, so why to widen the tax net. So this is just a clarification that now it is not per transferor or transferee, it is per property. If the consolidated aggregate value of the property exceeds 50 lakhs, then TDS will be applicable.
No, but there is a say when there are three people who are getting the remuneration, then how it is treated?
You
deduct
the withholding tax and you can divide it equally, or however you pay.
TDS gets.
Correct. Yes.
But for individual it is say 25 lakhs. Suppose 1 crore property.
No, correct. Suppose you have 1 crore property and it is going to 4 different people. So you are paying 25 each. So you will deduct 1% of all of that. Now assume that it is going to 70% is going to one person and 10% goes to the other 3. You will still deduct the TDS. So the TDS is deducted on the aggregate value of the property, not basis the transferor or the transferee. So like what is happening is that if you are 4 people buying a 1 crore property, people were taking the stand that no, I am paying less than 50 lakhs, so I will not deduct. So it was working both ways, per transferor, per transferee.
There are many people who are actually not in the tax bracket. One of property they say, and then.
That was the intent of the government when they introduced this provision. And that's why it's a nominal 1% which they are having as TDS.
You would have made it 0.1%.
Yeah, but
We are supposed to discuss here.
okay, the other thing is that we already know that when you buy a car over 10 lakh rupees, there is a tax collected as told by the dealer. Now they are expanding the same thing to certain to be notified luxury goods. So those will come up by way of a notification, and it is similar to the car which is presently being covered. They have also simplified a lot of procedural issues which relating to reassessment, relating to best judgment assessment, and they are also coming out now with the Vivad Se Vishwas scheme 2024. So there will be a lot of benefits for tax and for penalty and interest that is clear. The detailed scheme will be launched shortly. They have come up with incentives for funds set up in the International Financial Services Center. Right now we have one IFSC in Gujarat. So this is the benefits extended to funds operating from the IFSC. There are just some minor changes in tracking the misuses by companies in the life insurance business, where they were claiming certain expenditure while computing profits. Similarly, reporting of rental income from all property. There was an ongoing dispute between taxpayers and the tax department that if I'm running a mall, then there is not income from house property, there is income from business, and therefore all expenditure which was incurred by me is a business expenditure and not restricted to 1/3. There are several court decisions in favor of this argument based on the facts of the case. Now the government decides to close those different avenues and say that as long as it's house property, there will be income from house property, and you will only be allowed 1/3 deduction as otherwise allowed. Even for charitable trusts, they are streamlining the process. Right now, there are 2 sections under which a charitable institution can take benefits. They are streamlining the process and making it 1 section. There are a lot of conditions and compliances to be made. That is also being simplified. So currently, any charitable institution registered under 1 section will be allowed that exemption till that approval lapses, and then they will have to move to the new section. There was also there are several cases where there was a delay in payment of TDS, and though the company paid the TDS along with the interest, those taxpayers or such defaulters were being prosecuted. Prosecuted is a serious offence, and you could go in for compounding and things like that, but even that was being automatically being prosecuted. Prosecution notices were being issued. The budget now proposes that where you have paid the TDS along with the interest, then you will not be subjected to prosecution. I think that ends my presentation on the direct tax proposal. Sachin, over to you.
Thank you, Ned. The important thing was I was actually looking at the print. It's actually a fine print. Okay, so in that sense, there's a lot to kind of decipher and decode. And when I was kind of looking at things, I was raising my eyebrows. Yes, there's a lot to decode and look between the lines in that sense. On the indirect tax proposals, let me assure you that there are the print is still fine only, but it's not as complex as maybe from a direct tax standpoint. It's more on the procedures and other parts. So I'll make it make it a little bit bolder in that sense. I have some bold statements also. So on the indirect tax proposals, if you look at last month, the government came up with quite a few circulars clarifying a lot of processes, procedures, and also positions which were taken. Okay, so typically for corporate guarantees, for intercompany services, some things related to insurance. So the government came up with quite a few circulars which were enabling and clarifying certain positions. And this is something which was very very proactive in that sense. Instead of we going into litigations and increasing the size of litigations, they were coming up honestly and clarifying and taking cognizance of the issues which are faced by the industry. And I think the role which the GST Council has been doing, the 53rd GST Council meeting, the tracking and the entire mechanism is really meaningful, and a collaborative effort between the state and the center is getting reflected. And I think that is something which is commendable in that sense. On the coming to GST and some of the proposals that they have now discussed, though a lot happens in the council itself, but budget typically is not an event which was there, which was pre-GST. There's a lot happening on a monthly basis also whenever the council meets. But during the budget this time, the finance minister came up with certain provisions, again enabling provisions itself. So typically, in the interim budget, I did mention that there was a deficit in the income versus the expenditure, and it was almost 2 lakh crores. And how is it going to be filled in? So one of the questions was, are the inquiries, investigations, audits going to be increasing? And the answer to that was yes, it was increasing and it is increasing in that sense. One of the things was there is interest and penal provisions which are there under the GST Act. Section 73 basically is a section which levies penalty in case of non-fraud cases, and section 74 was for fraudulent cases. Now 73, if you wanted to invoke, the period was 3 years, and for 75 you could invoke a 5-year period. However, what the government has done now is that, and there were time limits within which the order had to be also issued by the department. So under 73 and 74, typically the time limit was only within 3 months from the issue of show cause notice. You had to finalize the order, right? However, they realized that this time limit is short, so they have actually increased, that time limit. But what they've done is they have actually restricted the application of section 73 and 74 only up to financial year March 24. So they've not omitted the section 73 and 74. They've only restricted that 73 and 74 will be applicable only up to March 24. Now if I apply it up to March 24, which means all the assessments and audits which have been happening, the time limits will remain the same. Now, a classic example in my case was I had an issue where we were requesting the officer to kind of pick up the issue under 73 because it's a 2-to-A reconciliation. There is no fraudulent intention in that sense. However, the officer said, look, my hands are tied, I can't do anything. I have to invoke 74, which is fraudulent and with an intention to evade tax. It's a 2-to-A reconciliation. Why? Because the time limit has expired. I don't have that time and I have to kind of assess. I said, even if you do so, I cannot pay penalty of even 1 rupee, because which means accepting a fraudulent activity. So his hands were tied. He said, I don't have an option. I've been given instructions in that manner. Now, to avoid the entire process, that you give adequate time, but classify a transaction. If it's not fraudulent, it is not fraudulent. If it is fraudulent, it is fraudulent. So therefore, what the government has done is they have restricted it 73, 74 up to March 24 and has added a new section 74A, which basically says that irrespective now whether it is fraudulent or non-fraudulent issues, you get a time frame of approximately around 5 years. You are supposed to raise a show cause notice, and thereafter from the show cause notice you have 1 year time frame available from for you to issue an order. So an order typically should be issued within around 5 years. Now what's the silver lining here? Is there a silver lining in such situations also? There's only one silver lining, that earlier I had to invoke, if let's say the time limit had expired, the officers were forced to invoke 74 necessarily for no fault of mine and levy a penalty which was equivalent to the amount of tax. But now with 74 getting triggered after March 24, the situation is you can, let's say, invoke a liability on me, tax plus interest, but there is no mandatory provision for me to levy an equivalent penalty. So if 74 is invoked, then a 10% minimum penalty can be levied, not an equivalent amount, right? So, is there a silver lining in such situations? Yes, there is, because at times we've seen practically also that officers do take a liberal view when it comes to penalty, but they take a harsh view on interest and tax amounts. Okay, so to that extent, there is a new provision of 74 which has been invoked. Again, penalties, there is a benefit if you kind of under 74, if we have to pay the tax within 30 days, then the penalties were reduced. But now that time frame under 74A has been increased to 60 days. So to pay the amount within 60 days, it's fine. Another connected issue was if there is an issue which was raised, let's say earlier, that the officer says this is a fraudulent case only, then the input tax credit on that was completely denied because it was covered under section 17(5), stating that if you paid a tax under 74, then input tax credit of that tax will not be available. So what they've done is they've amended 17(5), removed 74 from that section, but they have not added 74A into that section. Technically, whether it is a miss or otherwise, but if there is a tax which is paid, irrespective of whether fraudulent or otherwise, in that situation, input tax credit of that tax paid can be done. Right? So that's something which is there. Now, question is whether 74A can be added further or not. It's a different story. Is it a miss? Doesn't seem like, because if the intention was to add a 74, they could have just deleted 74 from 17(5). They could have added a 74 easily. Though income tax has seen a Vivad se Vishwas scheme coming in, what this time the government has done is they have incorporated section 128A in the finance bill itself. 128A is nothing but like an amnesty scheme which they have brought in. So for a period of 3 years, so for 17-18, 18-19 and 19-20. If there are any issues which have been raised under non-fraudulent situations, which is under section 73, then in that situation, the interest and the penalties can be waived off. Okay, is there an application to be made? So typically, any kind of an amnesty scheme will have a rule, a set of conditions. Officers may agree, disagree. There's a lot of back and forth. This kind of a scheme was never seen in the law itself. Okay, so 128A is an enabler, it's an amnesty kind of a scheme, but has been incorporated in the provisions, in the law itself. Right? Now, how does it help? The question is whether it is restricted to 3 years only. Later down the line, if they just want to make an amendment and extend it for some other reasons, maybe after 5 years, they can just make an amendment into that provision and the amnesty scheme can be made applicable. Right? So, this is a welcome move. Again, this is not eligible, erroneous refunds and other things if they have been claiming. In that situation, this provisions are not available, this waiver of interest and penalty is not available. This was something which was very much asked by the industry also, that during 17, 18, 18, 19 and 19, 20, initial years of GST, there's a lot of mistakes, genuine mistakes which were made because of technology, because of understanding of the processes. So this is absolutely a welcome move where interest and penalty have been made. But the only challenge is that what if you've already paid the interest and penalties? So they are very clear that if there is any interest and penalty which has already been paid, then no refund will be granted for that. Right? So if you accepted and you paid everything, then it's the pat on the back and move ahead. Another again enabling provision. So if you look at section 16(4) with regards to time limit for availing ITC. So ITC can be availed up to 30th of November. Okay, this earlier was up to 30th of September. Now, what the amendment states is that section 16 the time limits has been relaxed and a retrospective amendment has been made in section 64 that it will be applicable, that 30th November will be applicable right from 2017 onwards. So if you have any input tax credit, for example, one of my clients, the return, so the earlier date was up to 30th of September. So there was a substantial capital credit which was availed in the month of September. However, because of some technical issues, he was not able to file the return in the month of September, which is 20th of October. And as a result of which a show cause notice was issued. A substantial amount of show cause notice on account of capital procurements. Now that went into litigation, and because of this ruling, because of these changes, he is now able to avail that input tax credit. Why? Because the timeline of the October has gone to November. So to that extent, they have relaxed that the time limits for input tax credit is 30th of November, right from 17 onwards. Another development was in case of export of goods. So if you are exporting any goods and it is liable to export duty, in that situation, refund of input tax credit, input tax refunds were denied. So the is very clear. If something is liable to be taxed, we are discouraging those exports. Is why there is an export duty which is levied. So if we are discouraging exports, why should the input tax credit refund be allowed? However, the assessees were taking an alternative route, saying that instead of input tax credit refund was denied, why should I not pay taxes and take the refund of that tax back? So therefore, government has plugged that loop also to state that if you are paying any kind of duties on your exports, in that situation, no refund will be available of ITC or the tax paid on those export transactions, right? So that has been completely covered. One very interesting section which has been introduced, section 11A under the GST law. So it basically says that if there is any sector, okay, and traditionally these sectors have been charging a short levy. Let's say the GST rate on a particular transaction has been 18%. However, traditionally as a mechanism, age-old system involves that the entire industry has been charging at, let's say, 5% or 12% or something of that sort. In that situation, the government has the power, so they've introduced a section enabling that power, stating that they can, though the tax rate is 18%, they can relax basis this power to fall in line and give that benefit to the industry. So, though the tax rate is higher at 18%, the government can notify that in case of such goods, the tax rate will be 5% to take care of all the historic situations. Right? So this is an enabling power. This basically, for example, in one of the cases we were kind of looking at supplies of certain goods to solar power. So the question was whether solar system, the tax rate should be 5% or 18%. That was a substantial debate. What is a solar system? What is a wind power generating system? There was a lot of debate and discussions, and the entire industry was levying tax at 5%. There were a lot of DGCI inquiries which were being made. There was a lot of harassment in that sense also. Summons left, right and center to, across the senior management of the organizations. And there was a lot of issues around that. And, for one of the clients, you had a situation where in Maharashtra, the AR said it is liable to 5%, and the same client in another state, the AR said it is 18%. So a lot of variations in that sense. So the government has now, this is never, I've never seen this kind of a section in any of the legislation, be it VAT, excise, customs, service tax, never. So this is basically aligning themselves to the industry. Now this only reflects the intention of the government also. They want to understand the problems, they want to understand, this first recognize they don't know the entire industry. It is practically not possible. There's one law across, thousands of industries and sectors. They can't know, you can't create a customized law. But they recognize the fact that if there are variations, if there are industry practices, we will take cognizance of that. And if there is a gap, we will support the industry to make sure that it doesn't burden them. Right? So this is a welcome move in that sense. The appeals, the pre-deposit for appeals have been reduced. The first appellate authority, the maximum deposit would have been around 24 crores, 25 crores. It's reduced to 20 crores, so 20 crores is also very high. Parallelly, the GSTAT appeal pre-deposit amounts have been reduced from 20% to 10% and a maximum cap of 20 odd crores. So this basically defines the pre-deposit amounts. My problem is not about the pre-deposit. When will the GSTAT start? And I think that's something which is very, very crucial. Though the appointments have happened, but typically it needs to kind of have a timeline, time bound. It's almost close to 7 years, 6-7 years that we are kind of awaiting to have a tribunal in place. And I think it will go a long way to have a tribunal in place to resolve to. So for example, if I have a deposit, though you are reducing the deposit from 25 crores to 10 crores, but the money, if you are not going to form a tribunal, my money is getting blocked. So therefore, that becomes an issue. The other proposals are related to certain alcoholic